What is the zero lower bound? Have you ever wondered why central banks can't just keep lowering interest rates to stimulate the economy? This brings us to the concept of the zero lower bound. The zero lower bound refers to the point where nominal interest rates cannot go below 0%. Why is that? Because when rates hit zero, people and businesses may choose to hold physical cash instead of accepting negative interest rates on savings or bonds. This situation limits the tools available to central banks to encourage economic growth, especially during tough times. From a conservative fiscal policy viewpoint, the zero lower bound raises concerns about relying too much on central bank actions. When interest rates are at or near zero, governments often look to fiscal measures, like increased spending or tax cuts, to boost economic demand. However, conservatives warn that excessive fiscal stimulus can lead to higher national debt and distort market behaviors. Some central banks, like the European Central Bank and the Bank of Japan, have experimented with negative interest rates. These policies are controversial because they can hurt bank profits, discourage saving, and create unexpected issues in financial markets. Conservatives argue that maintaining the independence of the Federal Reserve is vital. They believe that avoiding long periods of zero interest rates can prevent political pressure that might lead to debt monetization or higher inflation. The debate around the zero lower bound connects with Republican priorities by highlighting the need for structural reforms. These reforms, such as deregulation and tax simplification, aim to strengthen the economy without solely depending on monetary or fiscal stimulus. By boosting private sector confidence and investment, these changes can help reduce the chances of facing a zero lower bound scenario in the future. For conservatives, it is essential that the Federal Reserve focuses on price stability rather than fiscal goals. This approach helps avoid long-term zero-rate environments. They often support clear monetary policy rules to prevent discretionary actions that could lead to asset bubbles or inflation. Practically, this means prioritizing debt reduction during times of economic growth. This strategy creates fiscal flexibility for future downturns. It aligns with conservative calls for balanced budgets and caution against spending that relies on deficits, especially when interest rates are low. In summary, the zero lower bound is a significant limitation in monetary policy that reinforces conservative arguments for responsible fiscal management and market-driven growth strategies. Understanding this concept can help clarify the broader discussions around Federal Reserve independence and national debt.